Hi, I'm Giselle. We've been talking about buying and selling businesses, and today we'll be talking about how to negotiate your business purchase. Did you know that you can negotiate your business purchase with little cash up front? Yes, it's possible. It's possible to buy a business with very little cash up front, sometimes no cash up front, but it always depends. So let's get into it. So when we talk about buying a business, it is basically structuring a deal. So how can you structure a deal with little cash up front? Basically, imagine that your business purchase is a pizza, and every slice of the pizza is a portion of the business, and this slice is how you pay for it. Imagine that one slice is cash, this is your own cash. Another slice could be deferred payments, another slice equity, another slice asset sales, another slice earn-outs. And maybe you have no idea what those words mean, so I will explain it to you in detail. There are many more ways you could structure a deal, but I will focus on the ones I just mentioned. Because they are the most used, and well, they are not so easy to create and to negotiate with the current owner. So first, the equity slice. This means that the current owner will still keep some ownership in the business, let's say 10%. Another slice of the business could be earn-outs. And what are earn-outs? Well, basically, if the company achieves XYZ revenue or profit in the future, then you pay for it. So it's a condition. If the condition does not happen, then you not pay for it. Let's suppose that it is a contract. There will be a large contract to be closed in the upcoming months. It's a long sales cycle, but if the client comes in, it will improve the revenue, it will improve the profit, and of course it will increase the valuation of the company. So if that is achieved, you can negotiate how to pay for that slice. It could be, for example, a commission, 10% commission on the total contract sales. But it depends. It could be many things. It could be a new product line. It could be a new client. It could be an expansion plan that is taking place, and it's still to be evaluated. Another slice could be deferred payments. So deferred payments is basically when the current owner gives you the capability to pay for the purchase over time. So it's basically paying for the business installments, and you can use the profit of the business to pay for it, of course. Let's suppose that you say you pay for the business within 2 to 3 years, and you make monthly payments to the current owner. This is a possibility. It's something that you can also agree, and this is another slice of that pizza. So far I have mentioned a slice, your own cash. Another slice I have mentioned is earn-outs, meaning a condition that is to happen in the future. Another slice I just mentioned is deferred payments or installments. And now let's talk about a fourth slice that you could use, which is asset-based. Asset-based sales could be a very powerful slice of pizza, because you go to a bank and you tell that bank that this business I am purchasing has property, has machinery, has assets, and I want to take an asset-based loan. Then you present, of course, the plan to the bank, the financial plan, the history of the business, and you take a loan in the name of the business, not on your own name, and then you use that money to pay the current owner. Of course, you can also use the current profits of the company to pay back the bank. Okay, so I have mentioned here 5 slices of pizza you could use to pay for your business purchase: cash, equity, deferred payments, earn-outs, asset-based. So I hope that now I gave you some creative ideas. You can go there, structure your deal. In my bio, you can find some templates, so feel free to use those templates. And well, in the second part of the video, I'll talk about how do you guarantee that the business has enough cash to pay for itself, because I've talked about deferred payments and you use the profits to pay for that. I talked about asset-based loans. You also use the profits to pay back the bank. And how do you guarantee that the business has cash? It could be that it all goes busted in the future. And to guarantee that, first you made your valuation, right? And I hope you made your valuation based on profits. I don't like valuations based on sales because they can be misleading. So here in this video, you can check your valuation based on profits. Now, you just think with me here. I have added all costs and all expenses to get the profit of the business. This means that I know the costs, I know all the expenses, I have already analyzed it, and I know that my profit is this much. And with the profit into your hands and being sure and making sure that nothing is missing on the cost side or the expense side, making sure that the business itself doesn't have any liability, any uncovered liability, for example, long-term loans or financing that could impact your profits in the future. Just making sure that you have everything noted down and that your profit is correct, you will know if you have the capability to pay for seller finance or pay for an asset-based loan. Yeah. So again, just make sure that your valuation is correct, your profit is correct, up to date, you're not missing anything, and then you can go and negotiate the payment structure with the current owner. It's all about rapport, it's all about having a relationship with the current owner and really making sure that you are negotiating how to pay for it over time. It's always great if you want to pay for the business with the cash up front and then you are free, but that's not really the case. And well, it's not the recommended approach because investing in a business, it is a risky investment, and if you can reduce that risk, paying for it over time and really allowing you time to build the business over time, really build in the sales, build in the profit, maybe changing a bit the cost, the suppliers, increasing the profit over time. That's the best way, because then you guarantee that you have a running machine into your hands that generates enough cash for yourself and well to pay for all liabilities of the business. Of course, here in this video I am focusing on business that have profit. Yeah, it could be that you found a business that, let's say, is generating 6 million in revenues and it doesn't have any profit. There is a possibility, of course, for you to acquire that business also using the same structure. Yeah, equity, earn-outs, deferred payments, asset-based loans. But you need to be careful. You have to restructure the business, do some financial engineering tactics just to guarantee you have enough profit to pay for it over time. And well, it's not the topic for this video, I would say. And with that into your hands, go there, do deals, and see you next time.